Good afternoon, everybody, and welcome to our webinar today on the subject of all change for UK small company accounting. My name is Alex Peel. I'm Head of Audit and Assurance at James Cooper Creston, and I'm joined today by one of our Audit Directors, John Bailey, who's going to join me in this presentation. Today we're going to look at the changes in the UK small company accounting regime. We're going to look at a bit of background, sort of touch on the UK Accounting Directive. Don't worry, I'm not going to go into too much detail on a EU directive, but then we're going to sort of move on to look at the key changes brought about by the new FRS 102 Section 1A compared to the FRISI, the Financial Reporting Standard for Smaller Entities. We'll touch on tax implications of the changes and also the new micro entities regime and look at implementing those changes. So just sort of starting off with a bit of background really, the new financial reporting framework is outlined in something called FRS 100, so Financial Reporting Standard 100, and then the detailed rules are in FRS 101 and FRS 102. The standard we're looking at today largely is FRS 102 and specifically Section 1A, which outlines the small company requirements. We'll also touch on FRS 105 for micro entities, although we do have a more detailed webinar on this subject in a couple of weeks' time. I think the point worth noting is moving forward, all other UK GAAP, so all UK accounting rules, is superseded. This completely does away with everything else that we've had in the past. So it's a fundamental rewrite of UK accounting. There's an alignment towards IFRS, that's International Financial Reporting Standards, but there are still important differences. And this replaces UK GAAP for all medium and large entities and also small entities, small companies, albeit that there are some changes between the rules for medium and large companies and those for small companies. As mentioned, micro organisations or micro entities can use something called FRS 105, which we will look at during the course of the webinar. So the EU Accounting Directive then. All of the changes really start with this. This was implemented in the UK fairly recently, and it does a number of things. Firstly, and this might be good for a number of people listening, it increases the small company size limits. So they've been static for a number of years. Previously, 6.5 million turnover has increased to 10.2 million. The gross asset limit has also increased. The employee number has stayed the same. It's also meant that the audit limits have increased to the same numbers and means that most small companies are exempt from audit. There are, of course, still a number of subtle areas where small companies do have to have an audit, but most small companies falling below those limits will be exempt from audit. And these new rules apply to accounting periods beginning on or after the 1st of January 2016. So they've already started, but obviously most companies will not have had to apply them yet because the first year ends we're talking about are going to be 31st of December 2016. Companies have been able to early adopt some of the new rules or all of the new rules, albeit that the audit limit changes haven't been, it's not been possible to early adopt those. So I've got up there significantly reduced mandatory disclosures in financial statements, which is true, and the EU directive essentially lists out the notes that a set of accounts requires to have in it. But at the same time, there are also a number of areas where more information will be needed. There are also a number of changes to the accounting rules and how you get to the numbers in the accounts, and obviously we're going to look at those during the course of this session. So if we just look at the time frame, as I mentioned, these rules apply from 1st of January 2016. Subject to various transition exemptions, comparative figures are restated, and it's important to know something called your transition date, because some of the new rules will have to be applied going back to the transition date. So I've got a couple of common year ends up there. So if you've got a 31st of December year end, obviously the first period affected by the new FRS 102 rules will be 31st of December 2016, and your transition date is essentially 2 years before that, so 1st of January 2015, and you'll see the other year ends up there. As I mentioned, there's some significant differences to the current financial reporting standard for smaller entities, and some of these could well affect reported profits in the accounts, and this obviously might have an impact on the tax you pay, bank covenants, the ability to pay dividends, etc., etc. There are also a number of changes to the format and content of the accounts that you will prepare. Okay, so before we get into the detail, we like to make these a little bit interactive if possible. We are going to have a quick poll, quick vote. So the question is, based on your knowledge of changes to the accounting for small companies, do you expect your accounts to either change substantially, change a little, or not change very, very much? Now, I appreciate that obviously you haven't heard the webinar yet, so you might not know the answer to this, but it would be interesting just to see what people are thinking so far, and then that might inform how we go for the rest of the webinar. So a couple of votes coming in, a couple more seconds on that, and then we'll close the poll and just look at the results of that. Okay, a couple more seconds. Okay, close it now. So it's interesting. Nobody thinks that the account's going to change substantially. And then roughly 50-50, so 55% think it'll change a little and 45% not very much at all. Okay, I'm now going to pass over to John, who's going to look at some of the key changes under the FRS 102 Section 1A rules.
Thanks, Alex. So the first area I'm going to focus on is lease incentives. So these are either rent-free periods given on property leases or reduced rent for a certain period over a lease. Previously, under the old rules of the FRISI, you used to spread this benefit over the period to the first break or when it was adjusted to market rate. Now you're not allowed to spread it to that first break, and you need to spread the incentive over the full lease term unless you think that a break is going to be used. There is an exception to this, a transition rule, where you can just carry on as before if you had a lease that was in place at your transition date. You can just carry on using the old treatment. So it's quite important to consider the treatment of any new leases entered into after your transition date. So if we just touch on a very brief example, if you take a lease that you were paying £10,000 for over 10 years, and you had a 5-year break in that with a 1-year rent-free period, then previously you would have to have spread £10,000 per annum for the first 5 years, and then under the new rules you will spread that 1-year rent-free period over the 10 years, £5,000 per annum. The second thing we want to focus on, and probably one that will impact on nearly all small companies, is the accounting for holiday pay. Previously, under the FRISI, there was no requirement to account for the benefit that staff had been accruing throughout the year but had not used. So if, for example, you had a holiday year end of December and you had an accounting year end of March, employees would have accrued 3 months worth of holiday to the end of March, but might not necessarily have taken it because they take most of their holiday during the summer months. So what you need to do is calculate an accrual to account for that value at the end of March. Probably one of the significant issues that companies may face here is going back to their transition date and going back to the comparative and extracting the holiday that people had taken at that time. And if people need help with calculating those accruals, that's something we can assist with. The next change is in investment properties. There's been a slightly wider definition, specifically to include properties that are rented from one group company to another. Previously, they couldn't be treated as investment properties, but given that they're in the same group, whereas now the new standards are very specific in that they can be treated as a investment property. Previously, under old FRSI, any changes in the market value or the fair value of those assets would have been reflected essentially through the reserves, whereas now there's a requirement to measure those or reflect those changes in the market or fair value through the profit and loss account. So this could bring in some quite substantial volatility in companies' accounts, especially if the UK property market continues to rise. The next point is that there's just been a bit of an alignment with the IFRS treatment, both for properties that are rented out and occupied by the organisation. I don't propose we spend too long on that. And final point is that previously there was no requirement to recognise any tax or deferred tax on an investment property unless you had committed to sell that prior to the year end. Now under FRS 102 you need to recognise the tax that would be payable on that property should it be sold based on the value at the year end. This is recognised through the deferred tax calculations. Again, something that we can assist with as in some instances, especially when property's been held for a long time, they might be quite complex. The next point is in respect of fixed assets. So there is an option under FRS 102 to do a sort of one-off revaluation of an asset that was previously either held at cost or held at revalued amount. And what this does is this will just allow you to sort of restate an asset value and then never have to change that value again except for depreciating it. So it could be quite useful where you've got things like plant and machinery which was being written off over say 4 years but actually still has quite significant value. Could be used to sort of boost the value of a company's balance sheet in certain instances. If you were previously revaluing an asset, then you could abandon that policy as part of this revaluation to a deemed cost. The next point is in respect of financial instruments. So this new standard is split into two sections: basic financial instruments, which are things like trade debtors, trade creditors, other creditors, bank loans, anything with a sort of normal market rate of interest or something that's really repayable on demand and used in the normal trade of the business. So in terms of basic financial instruments, there's not too much change at all there. The change really comes with non-basic financial instruments, which are things like derivatives, for example, foreign exchange forward contracts that you might be using to manage your foreign exchange risk. The requirements now mean that you have to bring these onto your balance sheet and recognise the fair value of those contracts. Now, take a forward exchange contract, the fair value is the difference between what you purchased that contract for and what you could sell that contract for now, or what you could buy an equivalent one for now. Now that typically depends on the exchange rates. So at the moment we would expect a lot of clients would have forward contracts where they could be making quite significant gains given the changes in forward exchange or in foreign currency rates since the Brexit vote. One of the key sort of challenges here is finding out what that fair value was at the transition date. You might not have the information to go back to that, and in the example of forward exchange contracts you might be able to get that from say the bank. One of the other areas this could influence is on say interest rate swaps, if you have any of those. And probably the area where this will impact small companies the most is in terms of directors, shareholder and intercompany loans. Now, if these are on terms where they're not repayable on demands and they charge no interest or don't charge a market rate of interest, then there becomes a requirement to discount these back to fair value. And what that means in normal language is that you would account for the interest that would normally be payable had you received that on market terms. So this can result in some quite large adjustments to the profit and loss account, and we would really need to consider those on a sort of individual basis. There have been some other significant changes, but we don't propose to go into too much detail during this webinar. The first of these is business combinations. Small groups are typically not required to prepare consolidated accounts, but where they either choose to or required to by, say, a bank, then the accounting for an acquisition is now different, and could result in the recognition of more intangible assets, such as customer relationships, customer lists, intellectual property, and the amortization of these intangibles could lead to differences in reported profits. There's a new option for the accounting for grant income, where you can either account for it using a accruals method, which was previously permitted under FRISI, or based on a performance method, so hitting certain performance criteria. There could be some quite significant impacts on tax in instances like that. The third one is biological assets, so things like livestock. There's now the option to hold these at fair value or cost. If that's something that impacts you, then worth speaking to your advisors. Next one is defined benefit pension schemes, probably not that relevant to many small companies, but there have been some changes to the way finance costs are presented. And lastly, share-based payments. Previously no requirement to account for share-based payments as a small company, just a disclosure requirement of the various terms. Now required to be accounted for at fair value. Now this might impact on a lot of small companies where they're, say, early stage startups and have issued options to try and incentivize and attract staff. The fair value calculations can be quite complex, but luckily there is one transition exemption here whereby you do not need to account for any share options that were in issue at the date of transition to FRS 102. You could choose to retrospectively go back and apply them, but there's no requirement to do so. There have been some changes in the format and language of the financial statements. During the first year, it's best practice to include a reconciliation between old GAAP or FRISI and the new financial reporting standards. The accounts are a bit more IFRS style, mainly in the terminology they follow, so a balance sheet could become a statement of financial position, and a profit and loss account will become a statement of comprehensive income. The accounting policies, where they do need to be disclosed under FRS 102 section 1A, tend to be far more wordy. And we've seen the length of some of the smaller company accounts we've prepared increase significantly. Luckily, as Alex touched on earlier, there's some disclosure exemptions for small companies, and there is a much shortened list of mandatory disclosures. The key things that the small companies don't need to do is not required to prepare a cash flow statement. They're not required to present a statement of changes in equity, which details movements from last year's reserves to this year's reserves, unless the directors believe that's required to show true and fair view. No requirements to prepare a strategic report and talk about the performance of the business. There's an ability to file what are now called abridged accounts with Company House, and as Alex touched on, has a limited number of mandatory disclosures. So what could the impact be on your profits? Potentially faster goodwill amortization, more intangibles on acquisitions, as we touched on in the additional information, holiday pay accruals, lease incentives, investment property revaluations, and potentially some derivatives. I'm just going to hand back over to Alex now.
Okay, thanks, John. So as we've seen, there are a number of key areas where changes may arise, both in the format of the financial statements and also on the profits reported. I should have said at the start of the webinar that if you do have a question, then there is the ability on your screen, hopefully, for you to ask a question, and depending on time at the end, we will also try and answer some of those. Before we move on to actually dealing with the transition, though, I just wanted to touch more on FRS 105 the micro entities accounting standard. So far we've looked at FRS 102 section 1A, which is the bulk of this webinar. But as I mentioned, there is this other standard which is available for some entities. You should have the limits up there on your screen. It's obviously not going to apply to all entities, but for some that fall within those criteria, it may well be an attractive option. There are some key differences though between FRS 105 and FRS 102, both the requirements for medium and large companies, and also FRS 102 section 1A for small companies. For starters, cost accounting is the basis for FRS 105, so no revaluation is allowed at all. So investment property, for example, is held at depreciated cost under FRS 105, whereas for years under UK GAAP and under the new FRS 102 rules, investment property has been held at fair value or market value. Under FRS 105, there's no deferred tax, and there's a number of other significant differences. So, for example, share options aren't recognised. The financial instruments that John mentioned are accounted for differently. Things like R&D expenditure is accounted for very differently. As I mentioned at the start though, we do have another webinar coming up on microentity rules and FRS 105, so if this is something that may apply to your entity, then that webinar will cover the differences in far more detail. So moving on then, we're going to look at a brief look at the tax implications for companies adopting FRS 102 section 1A, and those really fall into two categories: those that affect the quantum or the timing of the corporate tax charge, the actual tax that you pay as a company, and the changes affecting accounting disclosures but not actually affecting the tax that you pay to HMRC. So in terms of the actual tax that you pay, I think you've seen some areas highlighted by John where the tax that you pay might well change based on the changing profits of the company. So for example, the things listed out there will change the profitability of a company. So lease incentives will change the profit. Holiday pay accruals may well reduce your profit, so will reduce tax. Depending on how you recognise grant income, that may increase profits significantly in the first year and then reduce them in subsequent years, and with a corresponding impact on tax. And the sorts of changes as a result of financial instruments and derivatives that John mentioned will also affect the taxable profits of the company. So there are some things to be aware of there. Looking at the tax accounting changes, so this isn't necessarily going to change the tax that you actually pay, but it will affect the tax charge in your accounts. We're going to have more deferred tax. Deferred tax is something that accountants do and most other people don't normally get too involved in, and to date it's largely been related to capital allowances, tax losses, and a number of other circumstances. We're now going to get more areas where deferred tax is accounted for. So revaluations is a key one. So if you do have an investment property and you revalue it, you will now recognise the potential tax on the sale of that property. So we're actually going back to the position as it was around 15 or 16 years ago when you used to account for deferred tax on revaluations. They then scrapped that, but it's back again. And then there's a number of other scenarios. So for example, business combinations will lead to deferred tax arising, and depending on how they're treated, interest-free loans may lead to deferred tax, and there's a number of areas where that will be applicable. Okay, so moving on then, we've looked at a couple of the differences. I think it's important that all smaller entities now start thinking about the change to the new rules. As I said, we are there, it has started, and we will be preparing these accounts in a few months' time, shortly after Christmas. So in terms of planning for this, obviously it's going to be key to sort of review your accounts, review the numbers in your accounts, and think about whether those accounts are going to change at all. I think, as we mentioned, the format of all accounts will change. If you use a firm of accountants such as us to prepare those accounts, obviously the software we use will take account of the format changes largely. But it's necessary to look at the numbers in the accounts and see whether they will change as well. That will then lead to some information gathering. I think John mentioned a couple of areas, holiday pay accruals, for example, where it will be necessary to go back and find information from a couple of years ago. Now, it might be that once you've done that exercise, the potential holiday pay accrual, for example, isn't going to be very big, and therefore you might choose on that basis not to account for it. But it will be necessary to at least have a look to see whether such an accrual will make a difference to your accounts. Other areas, things like forward exchange contracts, where it will be necessary to go back and try and get information from the transition date to make the changes needed. I think then obviously timetable and roles and responsibilities, we'll need to look at the process for making the changes. In terms of doing it then, the opening balance sheet will need to be converted at your transition date, so it's not just the current year that we'll be looking at. So we need to go back to that date and redo the opening balance sheet and put through the changes at that date. The comparative period profit and loss account will also need to be converted. As we've mentioned, there are some changes which apply from now onwards, but there are others which you will need to go back and apply from that transition date. There's a number of disclosures that will be needed, and probably for the first time really, there's a number of disclosures which companies will need to think about whether they are required, because whilst they may not be mandatory, they are actually required to show the accounts, or enable the accounts to show a true and fair view. I think we've sort of covered the time period, but that sort of shows it again, this time with a company with a March year end, so 31st of March 2017 will be the first accounting year affected, but of course it will be necessary to go back to the 1st of April 2015 to actually get to your transition date. Sort of areas for early consideration, fixed asset values. If you've got fixed assets you want to revalue or have previously valued, then those will be something that you need to look at. Financial instruments, so forward exchange contracts, perhaps intercompany balances, loans from shareholders or directors, we'll need to have a look at those. If you've done an acquisition and if you've acquired another company and are preparing group accounts, we'll need to have a look at that. But also if you've made an acquisition and you've bought the trade and assets of a business, we'll also need to have a look at the accounting for that and the assets that you've actually acquired. And something that might well affect a lot of companies is this holiday accrual calculation. Okay, so we had a quick vote earlier on. We're nearly there with our webinar now, but we want to ask the same question again. Having listened to the webinar, do you expect your accounts to either change substantially, change a little, or not change very much? It'd be interesting to see if there's a difference compared to the poll we took earlier on, or whether actually it's still the same. So a few more seconds, the votes are coming in there. I think most people have now voted. Just a few last minute votes coming in there that have changed the result quite a lot actually. And we'll close that now. So again, nobody thinks that their account is going to change substantially, which is interesting. I think if you are a company which has share options, for example, or potentially has share options going forward, a company that has investment property, a company that has forward exchange contracts, for example, then actually you will have some quite significant changes to your accounts. Most people, 61%, think that their accounts will change a little, which is true. I think all accounts will change a little bit, and 39% of people with not much change. So in summary then, it is all changing. I know we've been talking about changes to accounting and changes to UK GAAP for a number of years now. So far it's only affected those medium and large companies. This time it does affect everybody, so all companies will need to do something. There's some key changes versus the existing standard used by most small companies, and now rather than just having that one standard, there are two options for some companies, and they'll need to consider the best GAAP to use. So in discussion with your normal contacts, it is time now to come up with a transition plan and to act now. So we're nearly done. I think we're pretty much up to time. Thanks very much for listening. We do have time for a couple of questions, though, if there are questions, and I do know we have got a question in there, which I will pass over to John to answer.
Okay, thank you, Alex. So the question we've had is, if we do a one-off revaluation of our fixed assets, does this still go to the reserves, not the profit and loss, like revaluations of new investment properties? So the one-time revaluation would be done as a transition adjustment, so would go through the sort of opening reserves as at the transition date, rather than through the profit and loss account in the first year or the comparative year. So it would only impact on the balance sheet, not the reported profits in either of the 2 years that you were presenting accounts for. So hopefully that deals with your question.
I think one thing that's worth noting on this, and it's not directly asked here, but it is relevant to any company with a revaluation reserve, is that if in the past, a company with a revaluation reserve has clearly showed that reserve separately within their balance sheet. Now going forward, revaluations will be going through the profit and loss account, albeit that profit isn't counted as what we call realised profit. So you can't pay a dividend out of a revaluation profit. So in theory, you could merge that revaluation reserve and your profit and loss reserve, but in practice, I think most people are going to have to keep those reserves separately so they know what they can pay in terms of dividends. In terms of other questions, I think we've got time for one more question. In terms of what someone's asked, does a company have to meet all 3 criteria to qualify as a micro-entity? For example, turnover small but a number of employees more than 10. So the rule on that is that you look at all of the criteria, and if you meet 2 of the 3 criteria, then you will qualify. So it's similar to the existing Companies Act rule. So if you're below the turnover limit and the gross asset limit but have more than 10 employees, then you will be able to qualify for those micro-entity rules. So I think that's all we have time for, unfortunately, today. So thanks very much for listening. There are some questions to which we haven't had time to answer. We will get back to people on those. As I mentioned, there is another webinar in a couple of weeks' time on the micro-entity new rules, so do sign up for that if it's applicable. Thank you very much.